Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And today I'd like to start our discussion on option Greeks. First, let's begin with delta. And why is delta important when you trade options? Delta is a measure of the change in the option theoretical value given a $1 change in the underlying. Why is this important? It can use to approximate what will be the price of the option if the stock moves by $1. And you can set your limit price and you can set your stop prices based on this information. So it's important to know what the relationship between the stock and underlying option in terms of the price of the underlying asset. So positive delta means when stock goes up, your option value is going to go up. When stock goes down, position generally loses value. If your option has a negative delta, when stock goes down, position generally gains value. And when stock goes up, position generally loses value. So you just need to remember one. Positive delta meaning that you're bullish. You have a bullish position. So let's go over the concept. Delta is a number between 0 and 1. Plus minus 1. That has a variety of different uses and interpretation, including a hedge ratio, including how do you figure out what the price of the option if the stock moves and stock changes by $1, and the probability that an option will finish in the money. The higher the delta, the higher probability that option will expire in the money. So when you buy an options, you want to buy options with higher delta, and when you sell an options naked, you want it to be with lower delta. That will increase the probability of your success. Let's look at the hedge ratio. Traders often use delta as a stock equivalency of that option. The delta tells the trader how many shares of stock to buy or sell in order to establish the offsetting position, to create an overall delta neutral position at the moment in time. What does that mean? Is that you want to know delta position, your overall portfolio delta. If you aggregate delta across all of your positions, stock and options, it can give you a sense of how much exposure you have to the market. And if you have a lot of exposure to the market, to the upside, you want to initiate positions that have negative delta, meaning they are bearish in nature. So if you initiate positions that are bearish in delta, your overall delta will decrease. That means if the market sells off, you will lose money. That's why the hedge ratio is very important. And you can see on your screen that long stock delta is 1, long calls have positive delta, and so on and so forth. So if you want to build a market neutral portfolio or slightly bullish portfolio, then you look at your overall delta and you look at individual deltas and you decide if you want less exposure to the market, then you initiate positions with negative delta. So let's go to one example. If XYZ trading at 105 and May 105 call trades at $1.25, what happens if the stock moves by $1 from 105 to 106? And you see on your screen that you take the original delta, $1.25, plus the 48 cents delta for that 105 strike price, and that's how you come up with $1.73. You can find out more information if you visit our webinars, and you can also follow us on social media to find out more information about delta and other important topics at options. Thank you.